Frosty the Snowman is here to tell you about accounting news on the IssuesWatch podcast. Hello and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. These episodes qualify for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. Quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or CLA. So I was ready to wrap up the year because this is going to be our last episode for the year. I was ready to wrap up the year and say, nothing's happened. Nothing's been happening. But what does the FASB do? They don't give you one, but they give you two new pronouncements before the end of the year. But we're lucky. I mean, in the past, there'd be 16, 17, 18 pronouncements that have come out. This year, and I don't anticipate another one coming out before the end of the year. This year, there've only been 4. So I'm going to go over ASU 2024-3 and ASU 2024-4. Obviously, you can follow those numbers. Anyway, so they're interesting. They're not going to affect all companies, so don't turn this off. Stay to the end. Listen to it all the way through because you know what Frank and I always say, what happens at one level usually trickles down and affects others. So the first one, ASU 2024-3, income statement reporting comprehensive income expense disaggregation. Okay, so I had talked about this a while ago, and it's finally out. And this focuses on the disaggregation of the income statement or breaking out more information. Now, let me go down, get to why this is out for a second. And the FASB said, coupled with recent standards that enhance disaggregation of revenue. So you remember, they came out with some disaggregation information on revenue. If you recall me saying a while back, if you don't remember, go check out the older videos. The chief operating decision maker, got him. The chief operating decision maker, they want more information that the chief operating decision maker focuses on. Who that person is, what their focus is, and they want that included in the financial statements. Now, I had said under previous sessions or at other seminars I've done, I find this interesting, and even within the body of the new pronouncement that came out, they actually mentioned the MD&A, Management Discussion and Analysis, which is the text that accompanies the whole filing for public companies. And in there, there's a lot more information that the company is commenting on income and fluctuations, stuff like that. They want some of that kind of pulled into the financial statements, okay? They want, and I'm sure their thought is the financial statements should stand on their own. You shouldn't be relying on the MD&A or other sections of the registration document to support the financials. If anything, the financials should be supporting that information. So anyway, the disaggregation of revenue and the income tax information. If you remember a while ago, the income tax information that came out said they want a lot more detail as it relates to federal, state, and international income taxes, the amount of payments, net of refunds, the payments broken out separately. There's a lot more, a big requirement regarding income taxes. So revenue, income taxes, what's next? The expenses. That's where they went with this. It applies to all public businesses. Remember what I just said before? Trickle down. The changes, here are the big ones. Disclose the amounts of the purchases of inventory, employee compensation, depreciation, intangible asset amortization. And the last one, depreciation, depletion, and amortization, DD&A, as part of oil and gas producing activities. Okay, so those are the big changes, but I'm going to go through more of the more requirements. Include certain amounts that are generally required to be disclosed under current GAAP in the same disclosures of the disaggregation. So if there are other disclosures, I'm sure they're probably talking about advertising. You hear why I say that in a second. Advertising, kind of start pulling all this other loose disclosure that's there together and put it as part of the disaggregation. Disclose a qualitative description of the amounts remaining in the relative expense captions that are not separately disaggregated qualitatively. Disclose the total amount of selling expense and the definition of selling expense. Okay, that one I found, well, the employee compensation, but that one I found interesting. So let's talk about employee compensation. Here's their definition of employee compensation. I'm going to only read part of it. All forms of cash consideration, including deferred compensation, share-based payments arrangements, medical care benefits, pension benefits, post-retirement benefits, and non-retirement post-employment benefits, including special or contractual termination benefits given by the entity in exchange for services rendered by employees. This includes compensation costs arising from wages, salary, profit sharing, bonus, one-time employee termination benefits, other post-employment benefits, employee stock option. You see it gets a little bit repetitive, but it's all type of employee compensation. Now, public companies have had to disclose payments and contractual obligations with certain executives already. So, and right now, if you look at a public company, financial, sales, cost of sales, SG&A, net income, whatever, discontinued ops, whatever, net income, it's grouped very much together. So they want some of this information broken out now in the footnotes. You don't have to break it out now on the face of financials. You can if you want, but most people are going to put it in the footnotes. The other one's selling expense. I found this very interesting. When the exposure draft came out, I think they were a little bit more. They give a little bit more guidance as to what selling expense is. They want selling expense addressed, and they're saying what they say is you had to go down to try and search for it. Rather than providing prospective guidance, the board decided to permit an entity to tailor the definition of the term selling expense to its specific facts and circumstances. Further, an entity shall disclose how it defines the term selling expense in the annual reporting periods. So what's been interesting is, they tried 606, the revenue recognition. They said, we're tired of all these different methods of revenue recognition. We want to have one method of revenue recognition. And after they came out with 606, they came out with around a dozen different guides on how different industries treat it. So they keep trying to say, we're going to do things one way so everything can be comparable. And in the end, they allow or it requires disparity and different treatments. And even here they're saying, okay, we want selling expense broken out so then you can compare the different companies and have more comparability. But now wait, your company can define selling expense different. So it's while it's more information for the investor, which is what they're shooting for, it may not be as comparable when you start looking at the different entities. But that might not be their goal. They just want the investor to have the information. It's effective for annual reporting periods beginning after December 15, 26. So for calendar 27. The next one that came out, watching the time, the next one that came out is debt with conversion and other options. Okay, this is 2024-04. Induced conversions and of convertible debt instruments. Okay, so a lot of people may not have this, but what I want you to focus on and think about is interest rates have gone down, and some are hoping that they continue to go down. And with this happening, there might be some change in some debt agreements. Now, this doesn't relate to this, but I want to have you just think about it as the years go on, and you're going to be coming up to your next reporting period, the year-end reporting period for calendar year. Think about your financial statements if debt arrangements have been restructured. Okay, and if they have been, they might have some sort of accounting effect on it. Just keep that in mind. But let's go back now to 2024-04. That talks about induced conversion of convertible debt instruments. All right. It clarifies the requirements for determining whether certain settlements of convertible debt instruments should be accounted for as an induced conversion. So you heard me say that twice. You're saying, what the heck is an induced conversion? So I went and checked it out. An induced conversion, and this comes from one of our members, their website, I couldn't find it in the actual guidance that came out. I Googled it and it was on one of our members' websites. So thank you for that, members firm. An induced conversion involves a situation in which the conversion privileges is a convertible debt instrument that are changed, and an additional consideration is paid to the debt holder for the purpose of inducing prompt conversion of the debt securities. Okay. The change terms may involve, now this goes back to the guidance, the change term may involve the reduction of original conversion price so that the additional shares or stock is issued, the issuance of warrants or other securities not provided in the original terms of the agreement. Okay? So some people are like, he's talking about public companies, he's talking about this crazy debt stuff. You may not have it right now, but you may have it in the future. Or you may be working or joining a company that all of a sudden has this. You should just keep this stuff in mind. Plus, remember, this stuff tends to trickle down, like Frank and I always say. So this one is effective for all entities beginning after December 15, 25. So this one's quicker. This one's earlier. Just keep that in mind. Watch it. And that's it. But that wraps up the year. We do have some other stuff that we'll be bringing up next year about some new PCOB stuff, some AICPA stuff. But I want to thank everybody. And in closing, I want to just give one sort of public announcement, address announcement. If you haven't completed your 20 credit minimum requirement for 2024, you still have time, okay? The NJCPA has events running through December, and you can get a list of all these credits. If you aren't sure about how many credits you have, you can go check your CPE tracker in your NJCPA profile too, okay? So get information for the events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. And for the year, this is actually our third full year. And hopefully you've been here the whole time. I want to thank you for watching or listening. And what you don't see, though, I want to say, is behind the camera, what you don't see is Jamie's over there. Okay, she's been here for all these years, extremely helpful. She hates when I talk about my arms, and I always do, just to bug her. Rachel's always here too, helping out. But the society staff is wonderful. Our members and everybody are wonderful. I want to thank them. I want to thank you. It's been a glorious 3 years.